Wall Street's wild ride. Uncertainty reigns as rate cuts hang in the balance. The stock market took a dip on Thursday, leaving investors scratching their heads and wondering what's next. But here's where it gets controversial. Just as hopes were rising for a series of interest rate cuts from the Federal Reserve, fresh economic data has thrown a wrench into the works, leaving everyone guessing about the future of monetary policy. And this is the part most people miss. The seemingly positive news about jobless claims and GDP growth might actually be fueling the uncertainty. Let's break it down. Initial claims for unemployment benefits dropped significantly, which is usually a good sign. However, when combined with the revised GDP figures showing stronger than expected economic growth, it raises questions about whether the Fed will need to be more cautious with rate cuts. After all, a robust economy might not need as much stimulus, right? But wait, there's more. Chicago Fed President Austin Goolsbee expressed unease about cutting rates too quickly, citing inflation concerns. This adds another layer of complexity to the situation. The Fed's dilemma: to cut or not to cut. Just last week, the Fed lowered rates by 25 basis points, the first cut since December, in response to signs of a softening labor market. They also hinted at more cuts ahead, with investors initially pricing in an 83.4% chance of another 25 bips reduction in October. However, that probability has since dropped, reflecting the growing uncertainty. Peter Tuzz, president of Chase Investment Counsel, summed it up well. The economic data that's come out over the last day or two is kind of confusing. It calls into question how much the Fed may cut rates again, and whether they need to cut rates again this year. As investors eagerly await Friday's release of the Personal Consumption Expenditures (PCE) price index, the Fed's preferred inflation gauge, the market is in a state of flux. Most S&P 500 sectors ended the day lower, with notable exceptions in energy and technology. Intel shares, for instance, surged 8.9% on reports of potential partnerships with Taiwan's semiconductor manufacturing company. Market movers and shakers: the Dow Jones Industrial Average fell 0.38%, the S&P 500 lost 0.50%, and the Nasdaq Composite dropped 0.50%. Among the biggest decliners was CarMax, whose shares plummeted 20.1% after reporting lower second-quarter profits. Even Accenture, which beat revenue expectations, saw its shares dip 2.7%. This raises the question: are high valuations finally catching up with the market after its recent record-breaking run? Rick Meckler, partner at Cherry Lane Investments, notes that valuations are historically high, but adds a twist. One big positive is it seems like the government is going to let big tech get bigger. With the all-important monthly U.S. jobs report looming next week, the stakes are high. The million-dollar question: what's next for rates? Monetary policymakers are divided, with some like Stephen Miran pushing for accelerated rate cuts, while others urge caution. Fed Chair Jerome Powell has emphasized the need to balance inflation concerns with a weakening job market. But what do you think? Is the Fed right to be cautious, or should they prioritize stimulating the economy? And with valuations at record highs, are we headed for a correction? Let us know your thoughts in the comments. This is one debate you won't want to miss.